In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Good morning, Market Rebels. Although, looking at the futures here, Stu, it doesn't look like it's going to be such a good morning. We're recording this early. Normally, we're live at 4 p.m. on Thursday, but it's now pre-market on Wednesday, and that's because we have another sales event on Thursday that's going to conflict with it. So we don't know how the market's closed today, so if you're wondering why we're not talking about it, that's why. But the futures, where are we right now, Stu?
We are not really looking pretty if you're long.
Yeah.
Futures are down about 900 points.
900, yeah. I saw them down 700 earlier, so they've been sinking. What is that, about
2.3%?
Yeah, I'd say closer to 2.5. Yeah, that's not a good hit.
S&P about 2%, NASDAQ about 1.58%.
Yeah, but it's the fact that it's been back to back to back. Yeah, just
I remember being in this kind of turmoil before on the floor, and it gets so exhausting after a while.
It's mentally exhausting, right?
Yeah, just get so tired from all the ups and downs and the swings. I mean, it's fun and it's exciting, and who knows what the outcomes will be, but it's mentally taxing for sure.
Yeah, it is. So anyway, we'll be talking about that, I'm sure, for weeks to come. But at any rate, we've got a good topic for everyone today that's related to this very idea of volatility. Now, remember, I know when we're in it, people say, it's horrible. But that's really what creates the opportunities. And so you have to realize it's just a necessary evil to get the returns. But what we're going to show today is, this is kind of like part two from what we did last week. Last week we showed the costs of rolling. And so now we're going to look at the other side of the coin, because we always tell people there's always a trade-off.
Yeah.
And if you can't specify those trade-offs in a trade or a strategy, you really need to wait on placing that trade.
Yeah.
So let's start off with our Chalk Talk question today. Rolling options reduces the compounding force. That would be maybe an argument for the negative, to try to either not roll or maybe not roll as often or as aggressively.
Mm-hmm.
But now let's flip that coin over. What are the benefits? Why would we even teach rolling if it was nothing but negatives?
We talk about that a lot, Bill, in our classes and our.
Yes, we do.
We always talk about rolling, and people ask us,
absolutely,
how do you roll? There are benefits for sure. There's a lot of benefits, especially these days. There's some benefits,
especially these days. So let's do that. So what are the benefits of rolling? All right, now I'm going to give people a little warning up front. There's a tiny bit of math that we usually try to avoid. This is something that, to make the point, just can't be avoided. However, don't worry so much about the math. You don't need to repeat it. You need to understand why this concept is important. We're just showing you the math, so we're not saying, we're just, sounds like it would make sense, and we're just pulling it off the top of our head. We want to show you that there is a real reason for this problem with volatility. All right, so here we're going to look at what are the benefits of rolling.
So last week, quick recap, we looked at a risk graph. So remember that we always get a bend at our strike. So here's a 100 strike. We get our little hockey stick graph. All right, so there we saw that we get maximum loss in this instance of 6. We have unlimited gains. Break even here would be 106. That's the 100 strike plus the $6 cost. If we roll this to the 105, remember rolling just means we're swapping it out or switching to. For a $4 credit, we switch from the black to the red. And the benefit is that we've now reduced this maximum loss by 4, but it costs us $1. We have to give up $1 on the upside. So it's an absolute classic hedge. We're giving up some, not all, of the upside in exchange for drastically reducing the risk or the downside. So you can see we've increased our break even from 106 to 107. And that's because we now have the 105 call for an effective cost of 2. Remember, we paid 6. We put 4 in our pocket. So on a net basis, we have 2 still to recover. So 2 plus the 105 strike is 107. Well, it used to be 106. People are going, where did that extra dollar? Why did we get shoved forward by $1? Because of this. We took, when we rolled from the 100 to the 105, we gave up $5 of benefit. Right? In a perfect world, we'd rather pay 100 for the stock than 105, or at least have the right to buy at 100 than 105. So when we switch over to have the right to 105, that's minus 5 to us. But we put 4 in our pocket. So that's another way to see why we're missing this dollar.
That's a great perspective, Bill. I don't think we've ever quite presented it that way, but that is absolutely fantastic.
Yeah. So that's this is why we tell traders don't get too aggressive with the rolling. We hear traders that say, "Oh, I rolled from the 100 to the 105 for 75 cents." That's just a bad idea. You're just doing a very mild synthetic sale and pushing that break-even point so far forward that you're probably going to guarantee a loss, albeit a smaller one. So anyway, if we go to another strike, let's say maybe to the 110, now maybe we've gotten this entire curve above 0. But now we've pushed it up 8 here, or reduced it by 8, I should say, kind of raised this floor. We took in a $4 roll the first time, $4 the second time, but now we've pushed the break even or reduced our profits by 2. And
So,
notice that 8
let's
plus
take-
2 is 10.
Let's take a second here. So let's take a listen to what Bill said again. So he said, I've given up the right to pay 100,
Right?
for the right to now pay 105.
Actually, 110 on the blue line.
Or if you go 2 times here up to 110. So I've now I'm giving myself the right to pay higher. Well,
Correct.
doesn't really sound very good. And I'm actually getting paid to do that, and that's your $8.
Right.
So where's the other 2? Well, you can see, I had to pay 2 to get that right. Well, now you got to say to yourself, well, why would I want the right to pay higher for the stock? So I think the part that we need to stress here as well is because the option, well, it gives you the right to buy the stock. It also gives you the right to walk away.
Exactly.
See, now you have the right to walk away at 110.
Right.
Instead of walking away at
So
108.
if the stock is falling this way, not that we've ever seen stocks fall, right? And we hit here, you can say, all right, well, now my maximum loss is I'm out.
I'm out, right? There's no.
But if we were on the red line, you'd have to wait to 105. You're going to take more losses. And if you have to wait to 100, you're taking even more.
See, what we're doing is we're really taking out the intrinsic value, the cash portion of it, with the discount of the insurances, and that's what the $2 is. But see, now you have to start looking at it as, well, yeah, okay, but now I have to pay 110. Really, that stinks. But the other side is, as always, now you have the right to walk away at 110, which is better than 100 on the way down. So look, it's a balancing act. There's no real answer as to exactly when to do it, or if you even want to do it. You have to say to yourself, I want that right. I want that insurance. I want to have that. And if you do, it's not free. And this is what it costs you. This is how you do it.
It's a balancing act.
So
this is, again, remember, a recap from last week. And the main thing was to show that rolling is not free. In this case, it's not hey, look at this. The market put $8 in my pocket for free. I'm generating cash flow. No, it's a cost. It is a net cost to you. So why do we still do it? Well, we still have unlimited upside. So we didn't give away the entire farm, just part of it. It's a classic definition of a hedge. So what we were showing last week is that because there is this, it's kind of a hidden cost that a lot of people overlook, don't account for. That's going to damage you in the long run when we start talking about compounding. So that's what we, even though there's a benefit, we said this is really a drawback. It was a hidden cost that people overlook. So now let's look at the other side. Why might we tell people to do this? All right, before we do, as always, please remember marketrebellion.com/get started right there on your screen. Lots of great things, videos, we have articles, topics just like this to help you get started, all free. And I can't emphasize enough why it's so important to have a good foundation. As you've probably found in a lot of our coaches' corners, super easy to get tripped up. A lot of moving parts with options. And if you don't understand the full picture, you're going to be left scratching your head going, how come I lost even though the stock went up? Bought this call. This is why. So now let's take a look at our long stock. And we saw that if we buy the put, right, we get this hockey stick graph. This is our insurance. And the reason that we would do it is to avoid this. And then we also saw that if we do a stock plus put on the left-hand side over here, that it is exactly the same picture as on the right. And this is the 95 call. So notice we have the bend at the same spot. Stock plus 95 put, 95 call. They're going to give you the same graph. And this is why we tell people, if you don't already have the shares, buy the stock replacement call. Push that thing deep in the money. You're still not going to pay the stock's price for it, but you're going to pay, you'll pay a lot less. It's still going to behave about like stock. So we saw with the problems here with, or the benefits, I should say, of having this bend. And a lot of times people say, well, Stu, why don't I just use a stop order, right? Why don't I just buy the stock and I'll just put on a stop for free? And it certainly makes a lot of sense. Why would I pay this option where I could lose money when I can just put on a stop? And there's a reason. Stu and I always tell people it's not wrong, but it's also not right. It's a trade-off. And Stu and I think, are generally in agreement on this. I can't tell you the last time, if ever, I've ever used a stop on an option, because this right here is your stop. So let's take a little more detailed look at why a stop and on an option doesn't mix like people think that it should. So traders often rely on stop orders to limit losses. But the thing that they miss is that stop orders are what are called path dependent. I'll explain what that means in a minute. And the options are time dependent. And so the thing that you have to do is to really think twice before using stops on options. This is not the best way to put them to their full use. So here's a good visual of it. Let's say our stock right here is at 100. And so we buy the stock. We go, I'm not going to deal with the options. I'm going to buy I'm going to put on a 95 stop. All right, so fine. What happens? The stock takes off and comes down here and it triggers, or what's the word we use in the industry? Elected. Right, that just means that it's touched. It's either touched it or gone through it, trading at 95 or below. So now it becomes activated. But now the question is, where's that stock going to go? And this is the misperception that traders have. Most people say, well, if it's in a downturn, it's obviously going to continue. So if I get out, I'm going to dodge this bullet. Well, you might.
Which might happen.
It absolutely might. But the key word there is might, because what's the other thing? Let's back it up here a little bit. It could also do this, make you look like a monkey. Are you going, man, I just got triggered out, and sure enough, the stock turns around. It must be the market makers. Yeah. They intentionally triggered my order. Fantastic. Now, obviously, there's a bazillion different paths that could happen. About half of them are going to turn out in your favor. In other words, that the stop order worked well, and the other half aren't. So the problem with the stop order is that its usefulness depends on the path that the stock takes. In this case, it wasn't real beneficial. It was just enough to trigger you out and then head up. And we've always said you could make a strong argument that if it's a downtrend that, yep, things aren't looking good and it's going to continue down, but you could probably make an equally strong argument for mean reversion. Maybe it's a better chance it's going to go up. Placing a stop is not really the best kind of an automatic form of insurance like people think that it is.
Or maybe it's going to do both. Maybe it'll continue to go down for a bit. And
right, it could come down here and then reverse. Right.
You're going to sit there and watch it, watch it
closely.
Just go back up.
Yep. So now let's take a look at if we instead said, you know what, I'm going to buy a 95 put. All right, so this dotted line is still 95. So now let's watch the stock. Now our stock is cruising along. What do you notice here? We hit down here, but we didn't trigger out. We still have our shares. We came over here, what happened? Hit that dotted line, didn't trigger us out. We came down here. We still have the right to sell for 95. It's as if we're up here on this dotted line. Even if the stock goes to zero, from our perspective, we're still at worst on this dotted line. Didn't trigger us out here on this path down, didn't trigger us out here. And so we can hold on for those unlimited upsides if they occur, and if not, we can always be guaranteed to get out at 95. So what makes an option work or not work is simply that it's alive. And that's why an option is time dependent, but it does not depend on the path that the stock takes. So for all of you traders out there,
you got to be in it to win it, right?
You got to be in it to win it, right?
You can't win if you're not in the game. That also means you can't lose, and that's what you think you're getting into,
right?
Which is where strategies come into play, which is where sizing comes into play.
Yep.
You can manage all of that stuff and stay alive in the time period without taking the time period out of it and letting the time dependency do its thing. You can do all. You just have to know how to do it.
That's right. So anyway, what we're showing here is this is why, at a minimum, you have to be careful about saying, I'm going to buy an option and put a stop on it. An option is time dependent, and you're using a path dependent tool to guard a time dependent asset. It's like mixing oil and water. We've got the hockey stick shape. That's the insurance policy. That's what you paid for. Don't use a free stop to trigger you out of the insurance policy. If you want to ride this thing for 30 days or 90 days, whatever your time frame is, then ride it. Why get triggered out early? That's one of the big benefits of the options. The gamma will do the hedging for you. All right, so those are some of the pros and cons, some of the trade-offs, things that you have to consider. But now, in honor of the volatility that we've had recently, we also hear a lot of people when they're building portfolios, right? We hear this all the time in Q&A. I want to buy individual stocks because what? They are expected to outperform the market. And why do you and Stu typically advocate, at least for the bulk of the portfolios, SPY and Q? That's like investor basics with training wheels. Who wants to do that?
No fun, boring.
No fun, boring. It's slow. You're never going to get a 30% gap on a day. It's never going to get bought out. Why do you guys keep talking about indexes?
Guess what? This game is supposed to be boring.
For the big money, it is. But we're going to show you a really good reason, one that everybody, at least most people, overlook because it's super easy to do, why there's a big benefit in going to indexes. All right. So, and it has to do with the returns. So usually when people make that argument they'll say, well, I read that, the S&P averages 8% or 10% per year over the last 10 or 20 years. But look at the stock. It's doing 25%. Wouldn't you rather have 25% than 10%, right? What do you need to? Well, it's not quite that easy. It's not that easy. And the reason is, when you're looking at the average return, it's not the way to look at it. And that's what people do. They'll say, I'm pulling it right up here in ChatGPT, and it says can see year 1, 2, 3. I can add them up and divide. That is the average. And here's the problem with it. We need to look at the average versus what's called the compound average growth rate. Sometimes you'll hear it called the CAGR. But at any rate, here's what the differences are. So traders, again, often consider just the average. Add them up, divide by the number, right? So we got 20 years of returns. We add them up, we divide by 20. That's how people look at it. And they say, Apple has returned this and the stock market has done this, so let me use Apple. But the better way to look at this is the compound annual growth rate, because that shows the true result, or what we might call what it feels like to move through time at those rates. So as a simple example, let's just say that we have 2 years. All right, so if you gained 50% in the first year and lost 50% in the second year, that'd be some good volatility. We add those up, we divide by 2, you could say, well, the average is 0, at least I didn't lose any money. But we know that's not true. So if we started with $1, when we gained the 50%, what happened? We go up to $1.50.
50.
And then when we lose 50%, we do what?
Lose 75.
Lose 25. We're at 75. So we have, on a net basis, have lost 25%. We started with $1. We now have 75 cents. So how is that 0? So what the CAGR is going to do is it's going to do these calculations. Let's take your dollar times 1.5 and then take your 1.5 times a half. And that's going to come up, if you do those calculations, take 1.5 times 0.5, you get minus 0.25. Actually, I'm sorry, you get 0.75, but it's saying you've retained 75% of your money.
Bill, take a second to just go over that left side again. See people up. You started $1.
Mm-hmm.
You make 50%, you're up to 150, and then you lose half of that. That's your minus 50%.
You got a bigger base to lose, right?
That is 75. That's half of 150, and you're left with 75 cents.
You started with $1, so you've retained 75% of your money, which is the same thing as saying you have lost 25%.
Right, because you started with $1.
Yep. So you can kind of see that's the way these calculations would work. Just punch it in on a calculator, 1.5 times 0.5, right? There's 1.5 times 0.5. It's saying that you're keeping 75% of your money. So anyway, the point is that when traders do these averages and they come up with a number, that's not really what you want to be looking at. You want to say, what does it feel like moving through time? And the zigs and the zags between point A and point B matter. We were just talking about this the other day in our Q&A when we look at things like TQQQ or any of these triple levered funds, bullish or bearish. It's this whipsawing that can have a net bleeding effect. All right, and this is something that everybody overlooks. Now, there happens to be a name for this, Stu. This idea that volatility is kind of pulling us down, right? It looks like we should be at 0, but we're really at minus 0.25. There's like some type of a extra hit here to our portfolio. And that is called a volatility drag. And there's a way, as you can imagine, that mathematicians have figured out. The math doesn't allow us to figure it out exactly, but there's a way, without actually going through the steps, that we can at least closely estimate it. And here's the way we're going to do it. We're going to take the average return. Now, here's where the math comes in again. Don't worry about it. We're going to explain it. It's the concept that matters. And with this average return in the previous example was 0, we're going to subtract off this little guy right here. Now, you might say, what in the heck is this? Well, this thing right here, which is called sigma, that by itself is volatility. All right, so it's the volatility that you all know and love, or today hate. Stocks trading at 20% volatility. Now it's trading at 80% volatility. If we were putting this into a calculator, that's what that number is. Look it up on your broker's platform. There it is. Now, if we square it, that just means multiply it by itself. We're looking at both of these. It's no longer called the volatility. They give it a different term called the variance. If you've ever had statistics, you will know what that is. It's just the standard deviation squared. Or if you take the square root of the variance, it takes you to the standard deviation. They're just really two different ways of looking at the same concept. But we're going to divide it by 2. So the idea is that we're subtracting half of this thing called the variance, or indirectly the volatility. So watch what happens. In the first example, we saw that we gained 50% and lost 50%. We said it was an average of 0. But what did the compound annual growth rate come up to be? Minus 0.25. So watch this. If you go into Excel and you put these two numbers in and you tell it to calculate the variance, just a statistical calculation, you're going to get 0.5. If you divide that by 2, you get 0.25. And look at that, Stu. 0 minus 0.25 comes up to that. Now, in this case, we got it exactly because there's not a lot of data in here. It's rarely going to be this exact, but it's going to be close. But the reason why we went from a 0 average to an effective minus 25%, and that's a big difference, by the way. You're thinking that based on your calculations, you're going to be at 0, and you're actually down here. Or maybe in a long-term portfolio, well, if I'm earning 8% per year, I should be here after 10 years, and you find out you're down because you're not accounting for the volatility drag, and that can happen on super volatile assets. All right, so that, again, the point to understand, if you don't understand the math, is just that there's this hidden force, variance over 2, that's causing a drag on your portfolio. And that variance is related to the volatility that you all know about. Now, little side trivia here, Stu. Where else have we seen this little guy right here?
Well, I believe we've seen it in the Black-Scholes model.
Look at this, everyone. Take a look at this right there.
Yeah.
Yep.
Those guys were smart guys.
They knew about that.
Yeah.
All right. So there's a reason why we've talked about this in Q&A, why we don't get exactly a delta of a half for an at the money option. All right. So if we do an at the money right here, this is going to go out to 0. We're going to take our rate forwarded by the time. But even if you put a 0 interest rate in, which is usually what I do, we still have this that is effectively compounding that growth rate. And that's why your deltas aren't going to be exactly 50. So at any rate, it comes up a lot in finance, and professionals know about this. Most people don't, and that's why they're led to think, let me trade Apple or NVIDIA or the TQQQs because I get all this added leverage,
right,
volatility, true. And but they just look at the average returns and they don't realize that that's not how it's going to feel moving through time. It's an easy trap to step into. We're going to look at some examples here, but before we do, quick reminder, marketrebellion.com/get started. All kinds of cool stuff just like this, articles, videos to help you make better decisions. So with that, let's jump over to an Excel spreadsheet and let's see if I can find it here. Okay, so I've done a little example, and what we're looking at is 5 different returns. So let's say this, whatever it is, stock or triple levered ETF, whatever it is, it made 25% in the first year, did 4% in the next, lost 12, lost 25, and then gained 33. That's some pretty good volatility. Now I did this so that we'd come up with an average of exactly 5%. So what a lot of people do is they say, well, if I had done this, I would have earned an average of 5% over those 5 years, or whatever numbers they're coming up with. Now, I did this to kind of keep the numbers easy, but sometimes they're coming up with things like 35 or 50%. They go, gosh, if you compound that out for 20 years in my IRA, that's going to be a huge difference. Not in the least, and that's because of the volatility drag. So now let's take these same numbers and we're going to find out our little CAGR over here. Remember, increasing by 25% is the same as multiplying by 1.25. Increasing that by 4% is the same as multiplying by 1.04. Losing 12% is the same as multiplying by what? 0.88, just 100 minus 0.12, or 1 minus 0.12, I should say. So if you come through and you multiply all of these together, you can see, for those of you who know Excel, I did the product. See, over here, it's the sum. It's saying it's the average. It's just add those up and divide by 5. Here, we're multiplying these out. So we're taking, let's say we have $1, we multiply it by 1.25, we multiply it by 1.04, multiply it by 0.88, and so on. And when you get to the end of that, you're up 2.68% over 5 periods, in this case, 5 years. I'm sorry, I took that, I did actually took that out. So it's the number's much bigger, but when you do it per year, it comes out to be 2.68%. So think about it. You're looking at 5% thinking that that's what you're getting, but it's going to feel like about 2.7, just a touch over half. So watch this. If we go into Excel, I can take the variance and divide it by 2, and I get 2.37. And if I take 5 minus 2.37, what do we get? 2.63, pretty close to 2.68. So again, that's a big hit because of the volatility. And that's just what people don't realize. So, I mean, let's pop in some other numbers here. Stu, what do you want to put in here? Let's do 50%.
Yeah, do 50. 50 works. Nice round number.
Let's see what happens here. See, look at it. Now, if you take the average, you'll say, wow, this thing's doing 8.4% per year. Nope, going to feel about like 5.2.
See where, let's do another one. Let's do 100. So do 90. Put 90 in there, Bill. Yeah, okay. So you might, think about market returns on average over time-ish, 10%-ish. If you were trading XYZ stock, Apple, Microsoft, Nvidia, whatever the name is, right? And over time you're making, I'm making 16%. Why would I put my money in the SPY?
Right.
See,
because SPY is about 0.2.
Right. So now you're taking on all that single stock risk
and drag.
And you have that drag in there. And when you push that drag into it, it really comes down to around 10, I'll round a bit here, 10%, which is what the market's going to return on a much more diversified basis. So you're really taking extra risk. We call it single stock exposure risk.
Right.
For
really no reward. Right.
For nothing. Yeah,
right.
For nothing. So
now also, as we've talked about in the SPY or the indexes, the dogs get kicked out. Right? It's kind of built to always survive. It's never going to go to zero. You also have extremely low expense ratios, which you don't get in other things, other assets. So the whole point was to show when people bash SPY and Q, it's because they say, well, the average is, and I'm making up numbers here, 8% per year, and this stock XYZ over here is doing 24%. Would you rather have 24% or 8%? Well, that's not understanding the whole picture. Because we could also say, would you rather have 8% with 20% volatility, or would you rather have this one with 85% volatility? That's why you're getting the bigger returns. And that stuff starts to add up really quickly.
Now, let's push that earlier argument into this discussion. Let's say you have these stop orders. You're playing around with stop orders in this high volatility stock, and you're getting stopped out, trying to get these bigger returns. Now who's the knucklehead, right? See, now you're not even allowing yourself to get these bigger returns.
To even get the returns, right? In fact, you're digging a hole.
Digging a bigger hole.
You're digging a bigger hole.
Yeah.
Whereas if you just said, let me take the SPY or take nibbles at the SPY or the Qs. So anyway, again, we're not saying it's right or wrong. Stu and I are always very careful about that. We're saying there's always trade-offs, and most traders don't recognize what the trade-offs are. We're trying to give you some insights to see our view when we tell people most of the time, especially if you don't know what to trade. It's an easy answer. Just do SPY and Q, or one or the other. I usually divide them up just so I don't get into wash sale rules. Right. So if you want to do some multiple buys and there's some sells in there, you can just leapfrog them. But that's a mild aspect of it. Split them up. But the reason we do that is partly because of this volatility drag is really small. And the expense ratio is really, really small. And when you compound that out, those forces into the future, it can make a big effect. So you have to be very careful when you're trading things like Bitcoin. This is one of the reasons I have always said that Bitcoin is going to struggle to outpace some of the other things, not because it doesn't move right quickly, it's because of the volatility. Volatility drag is going to absolutely kill you in the long run. Now, it's not saying it's bad. I'm just saying be careful of it. So anyway, we thought that was kind of a good thing to point out, especially for these markets. We hear this a lot, people saying, I don't know what to trade. We say, do SPY and Q. And a lot of times people say, why do you always recommend SPY and Q? You guys are professional traders. Shouldn't you be telling me to buy this unheard of penny stock down here where I might quadruple my money next week? Sure, you might, but you also might lose it all. If you truly don't know what to do and you're trying to put money in it, make it simple and make it powerful. And one of the main reasons that we tell people this is because of the volatility drag. So anyway, hopefully that gives you some things to think about. Stu, any other things to close with here?
Yeah, so a couple things here. So again, just to reiterate, we're not saying don't ever buy a stock. Nobody's ever saying that.
Nope.
I've bought stock through the years. One of the things I used to do is I used to buy a share pre-internet to get proxy statements.
Yeah, exactly. You had to, that you couldn't look it up on the internet.
Yeah. So, I bought stock through the years. A lot of them went to zero. Some of them hit big. In the wash, it really comes back to a return that the market provides. I mean, it's really that simple, give or take a couple of percentage points here and there. Right. But, and like might one stock, CoreWeave, I think that's the name of it, right? Isn't that the stock that just came out?
Yeah, right. CoreWeave.
Maybe that'll one that's going to make you a gajillionaire, or maybe it'll be the next Amazon. Who knows, right? Who knows? It's okay to do that. Just, do it with knowledge.
And right. Don't realize it's not as easy as saying, well, look, if we average up the past 5 years or 10 years of returns and then project it out, you are not doing the math correctly. You're not accounting for that volatility drag. You're not going to be anywhere close to those numbers.
Be an educated. That's all we try and do.
That's all we're trying to say. Right.
Do this, don't do that. That's not our job here. We're just trying to make you guys a little more educated in what it is that you're trying to accomplish. Really, by first saying to yourself, what's your goal, and then trying to figure out how to get there. And secondly, we talked about it a little bit, just on that whole rolling thing. Yeah, there are definitely costs involved, especially the compounding costs. There's also benefits. Just keep that in mind as well, right? If you've rolled an option, if you pay $20 for an option, and you've rolled it a couple of times and taken, let's say you took $20 out of it, and now the stock tumbles, the stock's down 40. Well, you're kind of okay. Right. The outcome didn't really work out like you would have liked it to work out, but the option did exactly, and the strategy did exactly what it was supposed to do. It was supposed to hedge your downside. That's why you bought the option in the first. That's the main reason why you bought the option in the first place. Where people kind of think, well, I'm buying the option because I want to be on the game. I want to be on the train when it goes up. That's like an effect of what the option is going to do based on the path that the stock takes. The real benefit is the downside protection, or the hedge that you get when you own that right to walk away. Yep. Instead of looking at it as the right to buy, look at it as, in addition to that, look at it as the right to walk away, and the whole picture becomes much more clear as to the hedging effect that option could actually provide,
especially in these markets. So let's come back and answer this. This, of course, is not going to have a clear-cut answer like a lot of these do. Rolling options reduces the compounding force. That was last week, and we were saying that was kind of a negative. So what are the benefits of rolling? Well, Stu just outlined a bunch of them, but the one that we really wanted to highlight here is that if you are in volatile markets, not that we've ever seen volatile markets before, what can happen? The volatility drag can be a real destroyer. And if you can hedge let's say, roll when times are good, get some cash on the side, and buy it when times are bad, that is something that could outdo the compounding force. And that's why it's really hard to say which is right and wrong, which is why we say if you're unsure, probably split the difference. Do some rolling, just be very careful about how you do it. And so we hope that gives you, again, some things to think about. Stu, let's see what happens with our markets today. Maybe we'll get a turnaround one of these days. But we want to thank all of you for being here. Hang tight in these markets. Remember to stay with your goals and know your options and know your risk. And we'll see you next Thursday.
Yep, see you.